move on and take a look at some technical levels in the market. Certainly, we broke through many of them today. So what are the charts telling us about future direction of the markets here? Have we seen the worst, or is there more blood to come? Thoughts now from Louise Yamada. She's Institutional Investor's best chart analyst 4 years in a row. So, Louise, it is great to have your expertise on a day like we saw today. What do the charts tell you in terms of where we are headed?
Well, I think that the charts have been forewarning us of exactly what your prior guest, Peter Schiff, has told us fundamentally. The markets have been deteriorating for a year and a half. We have seen a total retraction of the bull market of the last 5 years. And I think that the 2002 lows, as we shared with clients a month ago, are very vulnerable. And I think that chances are very good that they're going to be broken. You think about either the Dow, or we could look at the S&P. And that very much to us looks like a double top, a massive double top, and you've got a critical 10-year support there at the 2002 low. And the bigger the top, the bigger the drop. We talked about this in financials, and look what has happened to the financials. They continue to go lower after the...
How big of a drop then, Louise? Let's take the S&P 500. How big of a drop are we looking for at this point?
Well, I think I would give you probably 600 to 400 as the next two levels that we would cite for the S&P 500.
See, when you're prognosticating catastrophe, it's more fun when you make it rhyme, Louise. So what you're saying is the bigger the pop, the bigger the drop. That's kind of fun.
Catchy.
Yeah, well, that was fun too. Now the bigger the, yeah, exactly. The bigger the drop, the longer the need for repair, so it's going to take a long time. But I think if you think about the Dow Jones Industrial Average, we have already 13 stocks that have broken the 2002 low. If you'd like a counting of that, Alcoa, American Express, Bank America, DuPont, General Electric, General Motors, Home Depot, Intel, Kraft Foods, Merck, Microsoft, Pfizer, and briefly Verizon. Now, if you start losing 13 of the 30 bricks in your wall, there's a very good chance that the wall is not going to hold up. And I think the possibility here of breaking is becoming much more valid, and that we have some serious declines still ahead of us.
So, Louise, if you take a look at all the charts out there, are there any asset classes that are giving you any sort of evidence that they are, in fact, stable? Maybe not going up, but stable relative to the drops you're predicting for the S&P as well as the Dow?
Everything is going down.
Everything is going down.
Everything is going down. You may have some relative outperformance, but it's been brief, and it has had a little bit of rotation. The consumer staples have outperformed relatively, but I think they're going to follow suit and join in the decline. And that's one of the things that's very different from the bear market, say, in 1981-82, where we had enormous bases in the consumer staples, ready to take the lead after and during the bear market. But we don't have that today. We have no bases. We have top after top after top, and I think we're looking at a very serious decline, which probably reflects everything that Peter just talked about.
What do you guys here on the desk make of this doomsday scenario?
I mean, listen, Louise has had it dead on. I mean, we try to identify, at least what I try to do is identify trading opportunities within all the nonsense that we're seeing, and we've done a reasonably good job at it. Could it happen? Absolutely. It's very hard for people at home to play that game. When you play the apocalypse, as Jeff Turner says all the time, if you're betting for the sun to explode, you know what? If you win, what are you left with?
We're too big and ugly to be cheerleaders. It's a bad market out there. Prepare for the age of hobos. Teach your kids how to grift.
Louise Yamada, thanks so much for your expertise today. We appreciate it here at Fast Money. And coming up after all this doom and gloom, we look at what was